Hello children, hope all of you are fine. In my previous video, I had discussed lesson number 1 of macroeconomics. We had discussed about the real flow and money flow with the financial system. In this video, we will be starting lesson number 2 of macroeconomics, that is national income and its related aggregates. First of all, you see that there are three methods of calculating national income. When national income is calculated, we follow three methods. One is production method, second is income method, and third one is expenditure method. When we use the production method, there are also maybe the two methods. One is the total output method, and another is the value added method. Whatsoever method we use, the national income will always be same, whether we are using production method or income method or expenditure method. The value of the national income and the domestic income will always be same. First of all, I tell you that what is domestic income. Whenever we are talking about national domestic income, we say GDP at MP, or more precisely, we more commonly we call it GDP. But actually, GDP is not the domestic income. We have to add something more and subtract something more. Then that is called the GDP at MP. That is called domestic income. When we use production method and total output method, first of all, in total output method, we find the GDP at MP by multiplying the value of all the final goods. How do we calculate the value of all the final goods? The quantity of all the final goods multiplied by their prices. Whatsoever the goods are being produced in the economy, scooters, motorcycles, cars, books, pen, pencils, shoes, etc., their quantity multiplied by their price, that will be added to the prices multiplied by all the services produced in a year in a country. Remember that we will be taking only the value of final goods here. We will not be taking the value of intermediate goods, which you have read. What is the difference between the final goods and the intermediate goods you have read in lesson number 1. So we will be taking here only the value of final goods. The value of all the final goods plus the value of services, all the services, doctors, teachers, engineers, etc., multiplied by their prices. Prices means what remuneration they get here. That will be added and we will get GDP. So, in production method, when we adopt the total output method, we get GDP at MP. GDP at MP means gross domestic product at market price. When we follow the value added method, in value added method we add the values. We see the how much value is being added to any product at every stage. Like if the farmer has produced wheat and wheat is bought by the miller, he changes it into the flour, its value increases. How much value is added to it? We will see it. Suppose the farmer has produced the wheat of 1000 rupees. When he sells it to the miller and miller converts it into the flour, its value suppose increases to 1200 rupees. So the value added here is 200 rupees. Again, suppose that flour is purchased by the baker and he converts that flour into the bread. Then again its value increases and suppose its value becomes now 1400. So again we see that 200 rupees are added. Again, if we see this bread is being purchased by any person who prepares the toasts of the bread and sell it. Then again, suppose it becomes the total value increases to 1600 rupees. We see that 200 rupees are again increased. So farmers 1000 rupees, millers 200 rupees, then um, bakers 200 rupees, and the person who makes the toasts there 200 rupees. So the total value of GDP has come to be 1600 rupees. In this way, in this method, we add the values, how much value is being added at every step, and finally that is equal to GDP. Of course, in this method, we don't call it GDP, we call it GVA. GDP at MP and GVA at MP, both the things are same, but we call it in place of GDP, we call it GVA at MP. That is gross value added at market price. Then, by using national income, we calculate all the factor income of all the people, all the factors of production here by the way of compensation of employees, operating surplus and mixed income. What are these components we will see in the next video. Just now I am giving the introduction in this part here. And we find the NDP at FC. We won't find here GDP at MP. Remember it? In national income, first we find NDP and FC. This is found out by adding compensation of employees and operating surplus and mixed income. When we add all these things, we get NDP and FC. That is National Domestic Product at Factor Cost. Third method is expenditure method. In expenditure method, we calculate all the expenditures done by the residents of the country, and then we get the GDP at MP. Here also we will be getting GDP at MP. This is gross domestic product at market price. So remember that there are three methods of calculating national income. National income, first method is production method, that is divided again in two methods, that is total output method and value added method. In total output method, we find the total value of the outputs by adding the total value of all the goods and services produced in the country. We will be getting GDP at MP. In income method, we find the NDP at FC first. NDP at FC, that is COE, compensation of employees plus operating surplus plus mixed income. And in the third method, we add all the expenditures made on the final goods by the people of the country. That is, then we find the GDP at MP. This is GDP at MP, roughly is called the domestic income, roughly. When we find the GDP, after that we have to do something more to find out the national income. This is, first we will subtract the value of depreciation. Depreciation, we have read in chapter number 1. So we will subtract the value of depreciation. When we subtract the value of depreciation, this gross is converted into net. G becomes N. Then after that, we subtract the value of net indirect taxes. Net indirect taxes we get by subtracting the value of subsidies from the indirect taxes. So we get here IT minus subsidies. IT minus subsidies. We get the NIT. So when we subtract the value of NIT, we are able to change market price to factor cost. The MP is converted into factor cost. After that, lastly, we add net factor income to abroad. Net factor income from abroad. Net factor income from abroad, how we calculate it, we will be telling you in the next video in detail. Then when we add NFIE to this value, we get, in place of domestic income, we get the national income. So in this way, this is the way how do we reach to the national income. Here we got GDP at MP. Here we got GP at MP, both the things are same. In this method also we got GDP at MP. So we have to follow this process to get the NNP at FC, which is called national income. In this method, we have to take only one step. I will be showing you in my next video. Till then, goodbye.